All right, so welcome to another video. Today I want to share with you some insights on Twitter. We're going to go ahead and talk a little bit about that with a cheap butterfly. I've discussed this a little bit ago on one of the live sessions, but I'm going to break it down again just to give you another perspective on this and maybe change it up and tweak it a bit. So as we go into this, there's a lot of discussion about the Twitter stock. And if you want to get some more insight on some of the things that I do, definitely check out the website here at tradersfly.com. We have a live class coming up April 25th on market season. So this will be different option strategies in different market conditions, meaning like, hey, which option strategy do we do in different market conditions? You know, whether we have a grinding market, a market that's selling off, panicky. So we're going to be talking a little bit about that. So you could sign up. And if it's going to be live, if you miss it, it'll be recorded. So not to worry there. And if you want to check out some of the charts that I post, go to the Discord section. The link's going to be in the description down below. You can take a look at that. And there's some technical stuff. Okay, so let's go ahead and take a look at some of the things here going on with Twitter. And if you just look at the news side, you know, Elon Musk wants to go ahead and buy it out, $54.20, I believe, per share. That's kind of what they're talking about. So a ton of money there going in to possibly buy out Twitter. So we'll see how that reacts and behaves. But you know, they're looking to push that stock somewhere around this price level on the buyout. So whether that goes through or not, we'll see. But if you want to take a cheap shot at it, butterflies is one of the better ways. If it sells off, meaning let's say he just decides to dump his shares, this could go down, who knows, back to the 40, back to the 35. But if it pops, it could actually go even higher because just accumulation of shares and things that are necessary to make it work and happen. So I already actually have a butterfly on. I did this on a live session not too long ago, so just check that out. But it's kind of buried in there, so I wanted to make a dedicated video specific to this. And we set this up, and you can see already a handful of days into it. I think the live session that was done was about a week ago, and we're not making money a ton of it, and we're not losing a ton of money. But you know what you can do is set up some of these cheap plays, risking about 219. And if this does pan out and work out, you could make, you know, almost $100. So you know, 50% return is pretty good. So what I want to do is go ahead and set up a butterfly trade, and you could reevaluate it right again and say, hey, well, maybe now I want it a little bit closer. But what I'm going to do is go ahead and go to about the 15 days out. Why would I do this about 15 days out? It's because we do have earnings coming up. There's earnings right around the corner. It is set for 5.5, I believe. So if I look at this, there's 5.5, but double check on that next earnings thing. So I want to make sure I'm before that. Anything after that, I got May 6th, so that's already it's already past earnings. And if I was to do an earnings trade, I would go ahead and do a trade specific for earnings, but I would do that the day before. In this case, we are doing a trade for maybe this news event. So now what I'm going to do is I'm going to go ahead and look for something about a 30 delta. That's what I believe I did before, between a 30, you know, 20 and 30 delta. If you're more bullish on it, you could go ahead and be a little further out, but somewhere between 30 and 20 is kind of where you're looking at, because that's about a 60% chance of touching, or 40% of touching, between 40 and 60%. So if I look at a 30 delta, 30 delta is over here and a 20 delta is over here. So that also means probability of touching is double that delta. So about 30 to 60% of touching. So we're just looking for it to kind of touch or go in that zone. We're not even looking for it to kind of expire there. We're just looking for it to kind of move in that direction. And then we're looking to close that trade out. Now, if I feel like my current butterfly is having a little trouble, or if the market's acting weak, I might actually choose a stronger delta. I could actually choose like a 40 delta, where maybe it'll just pop a little bit. But remember, this is kind of a news-based trade, so I do have to give it enough room to move. Otherwise, it could actually overshoot my trade. So I'll go with around a 30, maybe 35, because the market's acting a little weak. And then we'll go ahead and we'll buy a butterfly. Okay, so I'm going to do a similar one to what I just did before, but we're just going a bit closer in. So the current one that I have, you know, it's basically breaking even, you know, profit and loss, nothing so much. Okay, so now right here, we'll go ahead and set this up. And I'm going to go to about a 5 wide spread. Okay, maybe 4, maybe 5 wide spread. And it's just going to make sure that I don't overlap my current position. So what you can see here is I got a 55 and a 55. So I don't want to overlap. So I might just do a 4 wide here, okay, rather than a 5 wide. Okay, and you want to make sure that lines up as well for the rest of it. Okay, so if I got a 51, 54, there's a 3 wide, so I'll have to go to 56. There we go. And this one, okay, we'll go a little wider. There we go. So now I've got a 46, 51, and a 56 spread. That balances it out. I'm only risking about $96 on this trade. And then I've got a 1-to-1 contract spread. So I could actually go, I'm going to go 4 contracts here. One of the ways and a trick for you guys is that if you go in and do certain things with 3 contracts and then another thing with 4 contracts, it's really easy to figure out which butterfly is which. So as I look at this, I've got, 363 and then I got a 484. It makes it a lot easier to actually just see, hey, which one belongs to what. So I could set this up. I'm going to get about an 8 theta, not a huge theta or anything like that. But I'm just looking for this to pop maybe a couple bucks and then I could take it off. If I do think it's going to really explode and pop higher to that 54, I would actually go even further. And I'm going to show you that example here right now and go a little bit wider. And I could construct a few different butterflies here to show you. So I might actually go to a 57 because I've already got one at 55. So it's kind of already the range. I'm going to go to about a 50, 58, 57 and do a construction there. And we'll do this butterfly, but then we'll also do, let's send in this butterfly here while we're waiting. And this will be, where's my Twitter position located on? It's in 50-50 or directional. So I'll put that in there. And we'll let that kind of work. We'll see if it gets filled quickly. And then the next one, what I'm going to do is, there we go, got filled. The next one that I want to do is go ahead and do another construction right here. And you can see my position's kind of building out. The next one I want to do is even further out. So I could go to like a 58 delta, or sorry, 58 strike, 12 delta, or 57 even. So let's go to 58 just in case it pops, but I'll do less contracts because it's like the chance of that working out is a little bit slimmer. So I'll put a little bit less contracts in here and I'll go about that 3 or 4 wide. So we'll go 50, let's see, 54. And now I have to check to make sure 54s are not anywhere else. And we'll go to the 62. There we go. So now look at this cheap butterfly. I'm putting on about $144 of risk. If this pops, you make your money back quite a bit. You make 100% of it back. You double it up. So it's a good butterfly, but the chance of this working out is very slim. So rather than doing 4 contracts, I would actually rather do like a 2 contract spread. Just put in $72, right? Because the chance of these working out here are less than the chance of these working out or the ones right at the money working out. So as you construct these different butterfly trades, what you'll see is, the one that has a higher chance of working out is this one. There's our peak, then this one, then this one. So the percentage continues to go up the closer they are because they're kind of closer. So the stock doesn't have to move as much. And all I'm doing really is just adding shares of delta for this. That's about 50 shares that I have, or 50 delta in this case. But think of it like shares. And I could just put on 1 contract here, or I could put a little more. But the one that is further out, like this one, why would I put this one on? Is because this one makes almost a 1-to-1 risk to reward. Like, you're risking 100 to make 100. The other ones over here, let's say I go with 484. This trade, I might be risking 400, but if it goes up in my favor a bit, I might only make $100, so I might only make 20%. Whereas the other one, you're doubling it up. So that's the big difference, is that these trades that are closer, they have a higher chance of working out, but you don't usually make as much. So there's a little bit of the trade-off. So we could go ahead and construct this one as well right here and throw it on. And now we've got a couple different trades working in a different way. And building out a little bit of a position here for a directional bet on Twitter. And this is how I might do it. If you're really, really thinking that things will explode up. You could tie in a call in there as well because you've got quite a bit of theta baked in, a little bit of theta, and you could do something cheap from a call perspective. But the only downside with a call is you got to go further out and you got earnings there around the corner. So just be a little more careful. Because that can really just burn that position. So anyway, this is the trade. I would kind of look to do something like this for a possible upside move. If you're doing a downside move, I might use something more like a diagonal. You could use a butterfly as well. It's very risk defined. So both would be fine, or even a defined vertical spread. So it's just a matter of personal perspective. Anyways, I hope that helps. Thank you so much for joining me. Enjoy your Good Friday and your weekend ahead. Happy Easter, and have a great weekend. So please reach out if you have any other questions or video suggestions, and I will see you on the next video. Take care.